If this is the correlation coefficient between the 2's 10's and the 10's 30's, when the correlation coefficient is negative, do the bond prices go opposite the curve or with the curve? And when I talk about the curve, I'm talking about the 10's 30's. Opposite or with when the correlation coefficient is negative? Because this is obviously something that we start understanding, isn't it? Because we're talking about the 10's 30's. We're talking about the interest rate curve on the 10's 30's. Because obviously one of the key aspects is that it actually should go in the same direction as the curve against the 10's 30's, because it's going in the opposite direction to the 2's 10's. So we can start to recognize that the majority of the time it's negative, isn't it? So if the majority of the time the 10's 30's is negative to the 2's 10's, then of course the bond price should be going in the same direction as the 10's 30's most of the time, and opposite the direction of the 2's 10's, right? So in other words, when the curve is negative, when the curves are negatively correlated, which should be most of the time, you can understand that what we should be doing when we reach the peak correlation is that most of the time we should be going in the same direction as the 10's 30's curve. When the curve is positive, we should be going in the opposite direction to the 10's 30's. Now this is actually quite a useful clue, isn't it? Because if it doesn't go in the opposite direction very often, when it does go in the opposite direction, we know that the correlation coefficient kind of peaks out at certain levels. We can start using these levels as possible turning locations, couldn't we, potentially? We could say, for example, if we come into these areas here on the positive correlations, which we see doesn't spend a lot of time in those locations, we might be able to find an opportunity to step into the deal, right? So we can start considering these ideas. We can start looking at those as little signals, little warning signs that there's going to be a possibility. Now remember, this doesn't chart bond prices, because we're still looking at the possibility of the bond price being negative or positive against the 10's 30's, which is a different correlation coefficient altogether, isn't it, when you think about it? So when we go about constructing this chart, we start being able to answer or ask those questions, especially if the bond has gone completely helter-skelter against the 10's 30's, because of the idea that once the correlations are negative, the bond will nearly always be going in the same direction. And when the correlation starts peaking out and changing, for example, here, and goes like that, we can see a complete change in the storyline. You can see it changes from that peak through to the other area where it starts to peak out on the other side, or trough to peak or peak to trough, that kind of concept. So we can always look at these areas where we can start to recognize the changes that take place here. We start looking at the changes that take place from the peak, for example, here, all the way down to the maximum trough position down here. We can start to recognize that the bond will be starting to change its directionality during those phases. Now, you've got to be thinking about this for a second, and you say, I've lost what you mean by this. It shouldn't be too difficult for you to pick up the thread on this one. It should only take you a little theoretical whiteboard to pick up a thread on this. If we look at the 2's 10's, if we say that this is the 2's 10's here, and we look at the 2's 10's, and we look at the 2's 10's, and we'll just draw some random swings. 2's 10's. Well, one of the things that we know is, in most normal cases, is that the 2's 10's, we'll just mark it as the 2's 10's, is the 2's 10's itself is nearly always going to be a negative correlation to the 10's 30's, right? Nearly always. We know that as the 2's 10's rallies, the 10's 30's falls, and vice versa. We normally expect to see that negative correlation. We don't always get the negative correlation. Sometimes we get little positive correlations or whatever. Maybe we get some ideas like this. I'm just drawing some random ideas about what this is doing. So obviously, if I'm doing this as a correlation coefficient, what's happening to the correlation coefficient between these two? And obviously, if we were to label this other line, this would now be the 10s, 30s. Yeah? So based on that storyline, what's the correlation coefficient most of the time? It's negative, right? So the correlation coefficient most of the time would be getting very strongly negative during that period. If that's going strongly negative, so I'm just going positive, but there we go. If that correlation coefficient is going strongly negative during that period, then of course we've obviously got the 0 point, and we'll just leave that on the screens there. If we've got the correlation coefficient going negative there, when we reach that level, and obviously we start changing here, it's still negative. It stays negative, doesn't it? The correlation stays negative at that point. It stays at -1. Now, what happens when we start getting into this kind of level here? Well, obviously, when we go to this point, the correlation coefficient actually is no longer negative. It seems to be turning actually a little bit more positive. And it goes through that positive phase until we start reaching this point here, where the negative comes back out again, doesn't it? We start drifting into that negative phase through that period, reaching a peak, trough, and then it goes back positive. And it goes positive to this phase here. And obviously when it goes positive to this phase here, then when the blue line starts to drop, of course, the negative correlation kicks back in, and the positive comes back out again, and we go back positive again through this phase here, and then we go back into a negative here, and then we stay negative from that point onwards, don't we? We go to -1, and we stay as -1. So you can see that in these environments, a lot of the times we can recognize this idea of price going opposite to the 10s, 30s, or positive to the 10s, 30s. We can start to recognize this idea, where we start to see positive correlations. When we start seeing positive correlations, the question is always about what direction is the 2s, 10s going in, and what direction is the 10s, 30s going in. If we know what direction the 10s, 30s is going in, and the correlation is starting to go positive, then we know that the breakdown on the bond price. Now, there's nothing specific in this, guys. It's not a revelation. It's not something that's going to start opening the door to incredible trade opportunities. But the point is, we should always know what we should be doing on a bond based on the directionality and the correlation coefficient that's evolving at that stage. So during this phase here, of course, we should be going in what direction? Well, of course, if the 2s, 10s is rising, one would imagine that there's a very, very high probability that bonds will be falling. So the bond will be going in the same direction as the 10s, 30s. So in other words, that's going to be the same direction, isn't it? That's going to be the same right there. So we're going to get that idea that the bond itself should be going in the same direction during that period. During this period here, it should still be going in the same direction. During this period here, when that changes, of course, the bond price will be going in the opposite direction to the 10s, 30s. So this is an opposite direction to the 10s, 30s here. This is us back into the same direction. Now remember, when I'm talking about same and opposite, I'm talking about the 10s, 30s, not the 2s, 10s. The 2s, 10s, it should always be opposite, right? Same direction again as the slope drops off. Opposite direction again as the slope starts to change. Same direction as the slope drops off again. Remember, it starts changing from opposite to same at this point here, doesn't it? It's not when it's negative, it's when it starts moving off positive. And opposite changes once the same comes into play there. The opposite kicks in there. So we can start to look at those ideas. We can start to think about where I could possibly buy or sell bonds from against the 10s, 30s curve. So when I'm looking at the 10s, 30s being in the same direction, we should obviously be pouring down into the negative. We should have seen some peaks prior. So when I start looking for those peaks prior, I can start saying, well, if the 10s, 30s has now got a big gap on it, but the correlation is now dropping back down into negative, I think the bond will start moving off those prints. So for example, if the bond was was left behind at a very high price, there's a great opportunity to start doing that bit of business, right? You may be saying, kind of right, but I'm still not 100% sure what that kind of means. Well, we know that the bonds in the 10s, 30s can obviously at times end up being completely different priced in terms of directionality. So when we look at, for example, a bond price here, and we look at the relationship of how this correlation coefficient's working out here, we can see that we go into this dropping phase here. Now the red line is bond prices. The candles are the 10s, 30s curve. We see during that dropping price, right? We see it going negative at this stage here. Well, when that's going negative, what direction should bond prices be going in? The same direction as the 10s, 30s. Bond prices should start going in the same direction as the 10s, 30s. So if that's peaked out, that means that they've been going in opposite directions, right? So the bond prices have been going up. It's peaked out into those areas. The 10s, 30s curve has been going down. There you can see it. The bond prices have gone in completely the opposite direction to the 10s, 30s. And that's what happens during this period. Once we start crossing over into negative territory, and we start making some pretty big gains on the negative side, this bond price on a macro scale is now massively overpriced. You see that? And this gives us a good clue that there's a very good opportunity to go short bonds into that massively overpriced top edge up here. And obviously that's exactly what happens. And then it does kind of something similar again here, doesn't it? When you see this changing shape into this phase here, you see that that peaks out and then it drops back into positive here. So when it drops back into positive, of course, you start looking at that drop back in and saying, right, it's going to go in the opposite direction. So the opposite direction when that goes into a positive phase is when that's starting to go back up again into that phase, that's that change taking place, isn't it? It's the change taking place. So what I'm looking for is when it goes negative again. When it goes negative again, I could sell the bond again, couldn't I? So when does it start going negative? Well, it starts going negative back in here again, doesn't it? It starts going negative back in there again. See how it goes negative? See how it went negative here? So when that goes negative, I start looking at what the bond, the 10s, 30s curve is doing, and if there's a little value divergence to the downside, that's exactly what I'm looking for, because I could sell my bond back into those high prices again, because as it goes negative, the bond, which is now overpriced against the 10s, 30s curve, is now going to be looking for opportunities to go short. It's got to. And the 10s, 30s curve drops back down again. So we can see this on a 30-minute chart. We can also see it on things like 5-minute charts. The relationship, whilst not as good, can still become visible on a 5-minute chart basis here. You can see how the curve and how the bond is interacting with each other. We can see in the short term at the moment, the idea is been almost dominated by the short side of the market here. But one of the things I'm always looking for is I'm always looking for when it goes positive, because that's going to give me an opportunity to flip the bond over. It's going to give me an opportunity to flip the bond over when I see the market going positive, because that's not the norm, is it? The norm isn't when it goes positive. The norm is when it goes negative. So when I see the norm going positive, I can start looking at the bond price, and obviously if it's gone positive and the curve itself has been declining, if the curve has been declining, for example, on the left-hand side here, if the curve's been dropping and we start going positive, I've got a really strong story that I should be able to sell that bond at that price and make some monies. When the curve goes positive here and I'm down into a bottom edge, of course, and I can look at the directionality of the run into that price area. I know it's not most visible, but because we can see where the bond is, it makes it a little bit easier. I can start buying the bond into that story. Well, it's starting to set up again here, isn't it? It's starting to set up again. We're starting to get that storyline having been at a peak positive correlation. We're starting to move back into that phase again there. And obviously, when it starts moving into that positive location, what is the trade? the trade would be the buy trade on bonds, wouldn't it? Because that curve is going up, isn't it? That curve has been going up when that positive correlation is starting to show up. Well, if the curve is going up, that means the bond price will probably be underpriced into the lows, and I should be able to make money by buying bottom edge bonds. Does that make sense to the bond traders? My trigger for the bond is just watching for that curve to change into a positive curve. As the curve changes into the positive curve, I know I'm going to have an opportunity to do some business. So I start watching the curve change into a positive curve. I know there's going to be an opportunity because the bond price will be mispriced against the curve itself. There's going to be an adjustment. And now if I can take advantage of that adjustment, I could make some monies. You can see that this adjustment here was at 7:45, 8 o'clock this morning, London. It was the perfect time of the day to buy into bonds. You can see that this adjustment here was perfect. There's a great opportunity to buy into bonds. Because obviously the bond, which when the curve is going up like this, and I start seeing the relationship is going positive, we should be trading opposite, which means that the bond price should be down at a bottom edge. The bond price, remember, we're not measuring bond prices. We're measuring the difference between the 2s 10s and the 10s 30s. But the bond price should be in the opposite direction from the 10s 30s, not the same direction. And when we start seeing it going positive, we know that that's probably not sustainable for very long. We know that. Yes, of course, we can get extended parallel shifts. We know all about it. But obviously, it's up to us to start thinking about the possibility that there is a change about to take place. Because following a parallel shift, the market is exhausted. Because everybody in bonds, there's no fly trades, everything's parallel. And that's a very difficult world to live in. And you can see that just by looking at this chart, right? You can see that it's a very difficult world to live in. You can see just how long the market stays as negatively correlated. But when it goes positive, my job now is to start trading bonds, right? As soon as that goes positive, I start saying to myself, right, why is it going positive? What's happening? I can see that the curve is moving up through that phase, and I can see the bond is moving down. So what my job, of course, is starting to buy bonds into that positive curve phase. I know there's going to be a long bond opportunity during that phase to now join the positivity of that phase. And I should be able to make money on the long side of treasuries coming off those prints. And obviously that's what I try and do. And you can see that if I bought the bond during that phase, we made a lot of money during that phase and so on. Well, it might be an excellent way for some people, and it might not mean anything for other people, but it's just another way of looking, Phil. It's just another way of looking at the markets to try and understand the relationship of the bond price to the 10s, 30s. Because if you don't realize that the relationship to the 10s, 30s is subject to the relationship of the 10s, 30s to the 2s, 10s, you probably won't realize that this was ever a possibility of a trade idea. But obviously, the more you realize how bonds move and the more you realize how the bond price ends up out of line with the 10s, 30s, the more the opportunity starts to show up. Now, of course, you could just visualize it. Anytime you see the 10s, 30s visually diverging from the bond price, you know there's an opportunity to flip the bond, right? Everybody knows that. Because obviously a steeper 10s, 30s, we know that that steeper 10s, 30s is usually a result of what? A flatter 2s, 10s. And if we're going to be getting a flatter 2s, 10s, we know that's usually going to be long bonds, and we can start predicting the long bond position. But this just keeps you in the background until it starts going positive. You know, you're waiting for it to go positive. You're not really looking for it being negative. You're just waiting for it to go positive, because when it goes positive, of course, you start thinking to yourself, that's the trigger. Because now the bond, now the 2s 30s is, now the 10s 30s is going into completely the opposite direction from the 2s 10s. And that's my trigger now. That it was going in the opposite direction. Now they're going in the same direction, which predicts the 2s 10s, right? So this is like a predictor. This going positive to me is like a predictor showing up on the screens. Yeah? So anytime it goes positive, it's predicting a change in the bond price. Anytime it goes positive, it's predicting a change in the bond price. And my job is to look at that change. So you could see, for example, it went slightly negative and then went positive again here. And you can see that that's a predictor that the bond price, because the curve was dropping, the bond price was going up, you would know that predictor was a sell. So we're using the 10s, 30s to predict the change in the 2s, 10s. Does that make sense to everybody, guys? So it's a predictor of changes. Now, when that predictor shows up, guys, it can really give you some interesting ideas when it goes positive. Now, sometimes the trade's gone and sometimes it's busted, but you can't actually physically see it. All you're doing is you're starting to recognize the bond price is going in the opposite direction to the curve price. I mean, you physically can see it. You know, if I look at the bond price, for example, down here, you can see the bond price is definitely going in the opposite direction, but it actually started a lot earlier. So we know that into that bottom edge, which is these two buy arrows that we put in earlier, you know that that's going to be a buy. I don't have to see the positive correlation on the coefficient to see that. But obviously when I see it very, very, very positive, I can start to recognize something. Now, there's a concern here because obviously it starts doing that there. It starts to drop off. And when it drops off, of course, there's always a chance that the bond will do the opposite to the 10s, 30s when it drops off. But if the bond's already done the opposite to the 10s, 30s, the chances are it's already finished, right? It's already done the opposite. So when that dropped off there, there was always a chance because of that happening that I might be in the wrong trade. But obviously when it starts to turn back round again and I say, wait a second, that's actually a good sign. We're back into the game here. We're back on the game here. And you can see that that's into that low bond price right there again. And we can pick up the long bond and take that trade away from that point just there. So the positive correlation is a forecast of something changing in the bond price. And when we see that positive forecast, we start looking at that coming into that territory there. We can see it obviously comes into the territory. You can always start forecasting it. So I could have started to forecast it a little bit earlier. For example, here, I could have started to forecast that last aggressive drop here because it wasn't just a drift off, was it? It was an aggressive drop here. Because the bond price was dropping, I could have started to see that as an opportunity to buy some cheap bonds. The closer it gets to zero, the better the opportunity of flipping the bond. When it goes positive, you're already seeing it. It's now a real trade, but it could be a real trade before that happens. So that's something you start watching. That's something you start looking for when it starts getting down into those very, very low territories. It doesn't even have to go positive, so long as you see that aggressiveness starting to show up. You know there's going to be an opportunity perhaps to spring into this. And obviously, if the market then does go positive, there's a very good chance the bond is at an even better price for you to keep building into that type of position. So, you know, when you're looking at an accumulation of treasuries, the accumulation of long treasury starts when we start getting down into these kind of minus 20s area. You know, when you start seeing this coming into the minus 20s, remember, this is not directional. This is not directional. This could be a buy trade or a sell trade because the correlation coefficient isn't a directional trade. It's just a correlation up or down. So when we start coming down into this area here around about the 20s, you should already be starting to recognize the possibility because you've already seen that phase, right? But as soon as you get into this phase here, you're starting to think to yourself, flip. This is the flip phase of the market here, starting to show up, right? So you start thinking to yourself, this is a flip. This is the time when I should be thinking about the possibility of bond prices because of the very simple reason. If we're starting to see this becoming a positive correlation, it probably isn't going to be a positive correlation. It means that something's starting to roll over at tops and bottoms, having been a negative correlation for so long. Something's starting to roll over. If it's the 10s, 30s that's rolling over, there's a very good chance that's because they think the 2s, 10s. They think the 2s, 10s hasn't got any further to go. And if they think the 2s, 10s hasn't got any further to go, guess what? They think the bond price hasn't got any further to go. So this is a prediction that bond prices are finished their move. This is a prediction that bond prices are finished their move. So the same thing happened here. This was a prediction that bond prices had finished what was ultimately a very reasonable down move, right? So this here was a prediction that the bond price, now obviously the price was dropping, so you know it's a prediction that it's going to be a buy trade into the low prices here. So this was predicting the bond price has finished its down move. And obviously, the more positive it gets, the bigger the prediction becomes. You know, you can obviously try and look at it early, but obviously the later you leave it, the more the chance is that you've missed the trade. So it's just a little predictor. It doesn't mean you can't trade when it's this direction here, but when you do trade when it's this direction, the more it goes down like this, the more it goes down like this during this phase, of course. One of the things you start thinking about is, well, you know, how long does it start moving? Well, that depends, because if this is positive and if this is negative and it's getting further negative, then if the price starts to outstrip the curve, then of course that means that the price is going to be a reversal trade. You may be saying, why? You know, because obviously this should be a positive correlation now. This should be a positive correlation. So if the curve during this phase here, you might be saying, but it's a negative correlation. Yeah, it's a negative correlation of the 2s, 30s and the 10s, 30s, not the bond price in the 10s, 30s. If the correlation is negative between the two parts of the curve, the correlation between bond prices and the curve should be strongly positive. So any change to that means that there's possibly an opportunity. So when I see this going very, very negative, and I see a bond price that seems to be a little bit ahead of the curve here, there's a very good chance that that's going to be rotational back into value. And that's something you can start to spot. You can start to recognize that. When this starts going like this, for example, when that starts to change direction there, you can see that the curve starts to steepen and the bond price starts to drop. And you go, well, there's no trade for me there. There's no trade for me there during that phase because that's expected, because the relationship is breaking down on the curve. So I don't start buying bonds into that phase thinking that they're cheap. But I do sell bonds into that phase because that's actually improving. That's a phase that's improving. So the bond price should be in line with what the curve is doing at that stage. This idea that the drop here in the correlation coefficient means that the bond price should be doing exactly the same as the curve. And if any time it's not doing exactly the same, so you can see obviously at the present moment, we actually want this relationship to drop, don't we? If we're long bonds into this phase here and this phase here, and possibly even this phase, what we're hoping is that this actually does that, and it does it for a long time. Because what we're hoping is that this actually does that, and it does it for a long time. Because obviously if it does that, you can see that the curve is still positive. So if the curve's still positive, what's going to happen to this buy on bonds? The bond price hopefully will keep going up and we'll make a lot of money during that phase, yeah? Because this going negative means that the bond price and the 10s, 30s curve will now be positively correlated, S being same, O being opposite. So we should know that the bond price being underpriced just now means that there's a lot of upside if the negative correlation starts to work for us. And the negative correlation is the norm, so therefore we have a high probability that we have a great chance of being long bonds and making quite a bit of money on this bit of business here. Make sense? Everybody goes, nope, that went completely over my head. Or does that make sense to everybody? You've got to understand correlation coefficients before that'll start making perfect sense. But if it does make perfect sense, then you know what I'm talking about. It's a good piece of evidence, guys. How did did anybody decide to use my my max long gold trade level? Well done if you did. You've just made yourself another $800.